Well, hello, everybody. I'll give a few more minutes just for some more people to roll in before we get this started off. But my name is Michael Schwartz. If you guys don't know me, I just started in the EDU program, so I'm kind of filling in by myself. Luckily, Brandon is here to help me with our first webinar of the year. So thanks, everyone, for joining and being patient with us.
Glad to be here.
Yeah. Yeah. And can everyone see? Yeah. Yeah, and can everyone see the Hotel Owners Academy and the financing for independent hoteliers? Everyone sees that main graphic?
Yep.
Perfect. Awesome. We'll just give it one more minute, and then I guess we'll start things off with whoever wants to begin. I'll just give it another minute. Yeah, at 24. All right, let's just get into it. So once again, my name is Michael. I am in education and a membership, so kind of a dual role thing going on here, but happy to be here with Arsh, Adi, and Krishan talking about financing for independent hoteliers. So welcome everybody, thanks for joining, and thanks for joining with the attendance as well. First one of the year, so let's kick things off.
Perfect. So we have Adi and Christian here who will be speaking from their respective viewpoints on financing for independent hoteliers. I'm Arsh. I represent the Independent Hoteliers Committee. I'd first like to thank Brandon and Michael from the AHOA team for helping set this up, and Christian and Adi for taking time out of their busy schedules to join us today. As you know, today's topic is financing for independent hoteliers. This is brought to you by the Independent Hoteliers Committee. In the lead up to AHOACon 2025, we'll be hosting monthly webinars to prepare for the Independent Hoteliers Workshop, which will take place on April 15th from 10 a.m. to 3 p.m. during AHOACon. We'll be sending out more information ahead of the convention so members can plan accordingly. And thank you for all the members for joining in today's discussion. I want to start off the conversation allowing Adi and Christian to tell us a little bit about themselves and the work they do. Christian, do you want to start off?
Yes, sure. Thank you, Ash. Thank you, AHOA. Thank you for everybody who's attending today. My name is Christian Patel. I'm the Managing Director of Geography Capital. I started my career in private equity in the early 2010s and transitioned to commercial financing in 2016. Under the leadership of my mentor, Rick Patel and Geography Capital, I've helped finance hundreds of AHOA members and their families. And in 2025, we hope to touch as many business owners as possible, inspire leadership and growth in our industry, and support those who need us most. Thank you.
Adi, you can go ahead.
My name's Adi Compier. I'm an assistant vice president at People's Bank, focusing primarily on SBA loans. I've been there since 2017. I've been focusing in the hospitality industry since about 2021. Closed a little over $100 million in loans. So I feel like hotels are kind of my sweet spot. So I'm excited to answer any questions you guys have on the independent side of things today.
Awesome. So we'll get started by asking a few questions to both of the guest speakers. Christian, what does it mean to be a loan broker for hoteliers, and how do you help your clients? Could you walk us through the process and what it entails?
Yeah, gladly. So loan brokers, I like to say we play a pivotal role in helping independent hoteliers secure financing. Our expertise across diverse funding options, and the ability to tailor solutions, ensure that hotel owners can secure the capital they need to be successful. If I could summarize the benefit of a client-broker relationship in three kind of pools, the first would be expertise and market knowledge. Loan brokers, very specialized in certain industries. Our company was specialized in hotels and hospitality. And loan brokers across the country, they have a deep industry knowledge and a very strong network with their lenders. This enables us to match independent hoteliers with lenders that are offering competitive rates and terms that not only compete on pricing, but also more so align on the unique challenges that an independent hotelier may face, such as cash flow variability or the absence of franchise backing. So I think that would be the first one. The second point would be experience and just being familiar with the process. Navigate a common comment we get from new clients is that the paperwork process is very heavy and it's burdensome and it takes a lot of time to get the process. And I'm sure Addie gets the same comments too. Working with somebody who is knowledgeable and familiar with that paperwork process can simplify the handling of that documentation and also ensure compliance between with the lender's requirements. Not only can it save time for borrowers, but it also can improve the likelihood of them getting a loan approval from a well-prepared application. And I would say the third thing is advocacy and negotiation. Brokers act as advocates for hoteliers, negotiating terms on their behalf. We leverage our relationship with lenders to secure interest rate that the client's looking for, or cost of capital the client's looking for, or certain repayment terms that they're looking for. So I think those are all critical factors and really align with the client to broker relationship.
Thank you, Christian, for that. I know going through the process myself, it's always amazing having someone who can bat for you and help with the paperwork portion of it, of course. No matter how many details you've gone over through those, it's always having someone who's prepared to answer those questions ahead of time for you and has a relationship with those entities that can make all the difference. Addie, from your viewpoint in independent hoteliers as well as SBA, how do you think that fits into this category of financing for independent hoteliers, and what benefits might that route have over any other benefit?
So traditionally, SBA is going to require a less down payment than a conventional loan. That's like a big selling point to SBA loans. SBA actually only requires 10%. You just have to get your bank comfortable with that. And going back to what you guys were just talking about, a good broker relationship that can advocate for the customer and their experience in the industry, that goes a long way as to getting your down payment down or interest rate, all that good stuff on the SBA side of things, because you've got a voice advocating for you that we already trust from prior relationships and prior deals with that broker.
Yeah, it's all about the relationships, right?
100%.
Moving forward, this will be questions directed at both of you. I know for myself, just finding a possible broker or a bank that's willing to work with you might not mean financial success for your business. Sometimes you have to take what's given, and it's like the saying, you can't have your cake and eat it as well in the finance world. Where are scenarios you have seen where investors or developers have had to make tough decisions on their financing roles, and what have either made a project successful or a failure from specifically a financial point of view? Christian, would you like to go first?
Yeah, sure thing. I had a client recently approach us. They were looking to purchase a independent hotel in Florida. We closed it last year. I actually pulled a copy of the LOI today, and just to refresh myself on the project. And the client approached us with a decision point. They wanted two options from us, and they were very different options that could have changed the direction of his future business plans. So they came to us first for a high leverage SBA 7A loan. And by high leverage, they were only looking for around 20% down. Again, this was an independent exterior property, less than 50 keys. It was 20 miles from a city, 30 miles from the nearest major airport. So the client wanted to explore something with 20% down, 80% leverage, but they also wanted to compare it to a lower leverage product, something that may afford them a better interest rate. So what the client's decision at this point was, do I want to put more money up front and save on an interest rate, or or put less money up front and pay a higher cost of capital as the property stabilizes? So we were able to deliver this, and the client ultimately went forward with the lower leverage product. They wanted to come in with 30% down, and they had the ability to do so. And in doing so, they were able to afford themselves a fixed rate of 7.5% for the first 3 years. Now, if they had gone with the 20% down, the 80% leverage, their interest rate was more so a variable rate interest rate at prime plus 1.25, 1.5. So the cost difference, so I think that's a pivotal moment for clients. Making that decision between, do I put more money up front now and look for a lower cost of capital to carry, or do I put less money up now and bear the expense for the first few years?
Adi, do you have any examples yourself from perspective of different SBA programs where a client might have to adjust their business or even their development based on what SBA program they choose?
So on 7A, which is typically what we work with at my bank, there's not a whole lot of differentiation that they would have to change there. But no, like on a 504 loan, they do have stricter requirements for especially construction or down payment, because 504 allows you to have that fixed rate like he was just talking about. But I won't lie and say that I know a whole lot about 504 just because we do those very sparsely. So on the 7A side of things, it's not a whole lot to change, but definitely the variable interest rate for 7A is a huge kicker for a lot of buyers. But it does offer new hoteliers to get into their first business easier, because SBA is developed for first time buyers and trying to make the process easy for them.
So market trends would be closer to 7A on SBA, which also helps new hoteliers and not only independent hoteliers kind of break into the market.
Yeah, 7A loan, your interest rate is going to be based on prime most of the time, so your economic factors definitely play a heavier role on the 7A side of things.
Perfect. All right. Adi, do you yourself have any recent hoteliers or developments you've worked on where there might have been changes in their financial structure based on these caveats?
About like money down, or like what financial structure on what?
Yeah, money down, or why they might have had to even choose to go from independent, like going from independent to branded because the business model might have not worked.
So from a bank standpoint, I think a bank will always tell you that they're more comfortable with a franchise, just because the franchise puts so many caveats themselves on the customer to keep things updated and all those good things that the bank likes, but the bank doesn't necessarily have to tell you that it's a requirement. I think that's why independent hoteliers have such a hard time finding financing. But as far as a, a franchise making or breaking a deal, I think that goes back to your relationship with your bank and your experience in the industry too. Because I would rather do an independent hotel for somebody that I've done business with before, that I know knows what they're doing in the industry, than I would a franchised hotel for somebody that is not qualified.
If I may add on to that, I think it really comes down to the time-tested risk and reward, right? Where if a business owner is considering a franchise property versus an independent property, the independent property is going to benefit the borrower or the business owner because their profit margin increases, but that comes at the risk of not having that franchise backing. And that's some of the difficulty that lenders do face. It improves the reward for the client, but it also it heightens the risk for the bank.
Absolutely.
Yeah, that's always a tough one, trying to convince a bank, even depending on the markets, even if you have experience, right? It can be a hard pill to swallow for some banks. Christian, what kind of trends are you seeing in independent hospitality over the last few years? It seems like a lot more financial institutions are willing to back independent properties, but I'd love to take your take on it.
Yeah. If we could start with the challenges that independent hoteliers face, right? And that is the establishing of brand recognition and managing operational flexibility. Without the restrictions or the guidelines to operate in with a franchise, a hotel operator can quickly deviate from that and degrade their business over time. So that's why it's important to have a strong operator, time-tested operator. Now, a time-tested strategy that we've seen over the last few years, and this predates the pandemic too, is that when we have a new buyer coming to the table, somebody with an idea, they have some capital, they have some experience, maybe they've been a manager at a hotel before, something like that. They would start with an SBA 7A program. As Eddie said, a 7A loan is a starter loan. It can be used to acquire, it can be used to stabilize the business and build that commercial credit history. And then within 3 years, that prepayment penalty would drop off, or at the end of the third year, the prepayment would drop off. And then the SBA 7A loan can be refinanced into a conventional loan as long as the market conditions are right and the business plans are met. I think a trend we've seen over the last couple of years that we've seen some owners really excel at what they do, but the market conditions have not been favorable. And that's put a damper on a bank, because banks that may not look at just one property specifically, they'll take data from multiple properties in a certain area and aggregate those, and they'll figure out if it's an uptrend or a downtrend. I think brokers work closely with hoteliers to understand their business goals and their financial health, and and their project specifics. This allows us to structure loans that accommodate their unique needs. And as we continue forward, I think that time-tested strategy continues. As soon as we're able to work out at the start of the loan, we can work into a loan that's more flexible, that's more favorable to the borrower, perhaps. And they can continue their growth plans, perhaps using another SBA 7A loan on the next property that they're looking to expand with.
All right. Thank you for that, Christian. Addie, working at a local bank level, what are the trends you're seeing as in your community and in your state or your community when it comes to independent hotels? And especially, I know one of the things you done very well is helping hoteliers get their finances together, working on their paperwork, especially when hoteliers might have a tough time taking care of that portion of the business plan compared to operating the business itself.
Yeah, I try my best to do as much paperwork as I can without having to ask for it from the customer. Because that does take a huge load off of them, and that goes back to a good broker is so important because you're doing a lot of the paperwork too, and then we're communicating about the paperwork, and the borrower has no idea about all that's going on. That's why so many people have a bad taste in their mouth about SBA because they've tried to do one by themselves, and it is a lot of paperwork, but it takes a village for sure. So as far as like independent in my area, uh, I'm based out of Memphis, so I know a lot about just the hoteliers here, just because I'm friends with a lot of them and whatnot. But we lend in all 50 states, and so I have a vast understanding of that, and it's really, in my mind, more person oriented. So obviously the market's important, but especially when it comes to independence, there's such a special niche that I really think it goes back to the operator and relaying that the operator knows what they're doing on that side of things and less about complete market trends, because you can't compare the Memphis or the Nashville market with the Conrad and then go compare it to an independent outside of town. So I really like to stay focused on the operator side of things.
Could you speak a bit more on that? What are the expectations you have of the operator or a new client coming on board? How can they prepare themselves in meeting with you and really having a good start?
I really want to hear about especially somebody that's coming in as their first purchase. Like, I want to hear what you do at your current property if you're just managing it for a family member or been just having a desk job somewhere else. I want to hear what you do there and why you think it's time for you to get your own property. And then I also just I want to know what you plan on doing yourself at that property, which in the independent world is everything. Independent hoteliers wear every hat at the hotel. So just lay all that down and just don't ever think that there's a wrong answer to a question that the bank's asking, because we really do just want to know how it works, because we're sitting in the branch every day or we're at trade shows and all that good stuff, but we're not sitting behind a desk running a hotel. And so we want to hear the struggles, but we also want to hear what you do to fix them.
It's definitely a people business, right? Christian, would you like to add anything onto that?
Yeah, I think if I could give some advice as you know, as an application can go for an independent hotelier, attention to detail matters. You know, keeping your books updated and outsourcing non-operational services to industry professionals, accountants, legal professionals, etc., consultants. If a hotelier's growth ambitions are so strong, then it's a very small price creates a massive convenience. And as you're working with brokers, we can mask a lot of that, right? A lot of the a lot of the challenges that a hotel operator may have, we can help and improve upon those. But as they're working with the bank directly, and we always encourage our borrowers, through our process to speak with the banker directly too, in those instances, we want to make sure that the borrower is best represented and they're putting the best foot forward. If I could identify a document that I would really implore borrowers to really think about, it's the personal financial statement. Business owners frequently provide incorrect or incomplete PFSs. A business owner should take time to learn how to fill in the PFS accurately, because it's a document that trails them for the rest of their life, rest of their business career, as they continue to invest and as they continue to grow. There's lots of YouTube resources out there. There's lots of articles out there, and that's something that I think can really complement a well-prepared application.
Yeah, I know I've had difficulties my first time with the PFS as well, with millions of documents out there, finding the right one, working through it. Nowadays, you can just have pre-made Excel sheets, so that definitely helps, right?
Mm-hmm.
And asking for help, I think I know that working with your bank and if there's a great loan processor or broker at your bank and they know you, they're willing to help you through the process. So there's definitely always people in the industry willing to help.
That's right. And just to kind of comment on kind of feet on the ground, we have a very good team that crosses over Florida, Texas, California, that feet on the ground in major metropolitan cities, right? And just even if you don't end up working with that person, at least reaching out and asking that person for their opinion on how they feel the market is doing. They may know, they may not know, they may have a client they recently spoke to that has shared information with them that could be helpful. So I think utilizing that network really can help it and help independent hoteliers take that step forward.
Yeah, I know we have a small community in independent hoteliers with AHOA. We try to do the same with one another. Any information we can give on operations, financing, even just finding the right niche, matters. Marketing as well. Those are one of the tougher sides of independent hoteliers, is getting people to see your products. So you always need a good team or a place you can go for resources. As we get towards the end of this webinar, what is something that the both of you can give our audience to really chew on and think about before really maybe thinking about taking their branded hotels to independent and maybe trying to wean away, and how that could affect their loans and relationship with their existing bank? Christian, would you want to start that one off?
Yeah. There's a lot to consider when you move from a franchise property to an independent property. When a business owner wants to do that, there's an emotional attachment with that business owner. The idea is great. It works out perfectly in their minds. It may work out perfectly on paper too. But there's a lot of fact checking. There's a lot of circling back on those assumptions to make sure you are successful. One thing that you want to do in those instances is maybe order a feasibility report, right? A feasibility report's going to be able to help that independent franchise moving into an independent hotelier. It's going to help them kind of mark the market. Where does their pricing need to be? Does their change in business plan add to the market? Does it detract from the market? I think a lot of those instances are big factors. Another thing is working with your existing lender. Now, when that person is signed up for a loan, they have made an agreement with that bank that they are going to operate under that franchise agreement. And moving out of that franchise agreement is a substantial change in plan. It's a contract that's being terminated. It's a drastic change in the use of that property. It may still be selling rooms, but now it's lost to that franchise. So it's really an open discussion with the bank. As Addy said, you shouldn't be afraid of speaking of your banker, right? And being open and opening up that dialogue with the banker. You want to talk about your plans. You want to show the business plan, and a well-prepared application may convince that lender to say, okay, this is for me, we can continue with that. Or that may not be suitable for my credit box, and perhaps you may need to look at other lending opportunities for that. Whether or not they're asking for additional proceeds or not, it becomes a compliance issue because we're changing the franchise. Well, what we really believe in is supporting the client as a business person and not as not just as a borrower. You know, we want our clients to be stronger entrepreneurs at the end of the closing and not just the receipt of a new loan. So if the client can work with the bank and their existing lender and get them comfortable with that new business plan, that's always the most cost-effective way to do it. That's why we build lending relationships. But if you have to move bank because the credit box just can't work with an independent property, then that's the time we need to move bank. And I think that's again why brokers become very, very valuable, because we can reach different parts of the country to who may have appetite in that project.
Addie, would you like to add anything onto that?
I really like your feasibility study point. I've had several customers that have existing loans with us that have come in and either wanted to change franchises to a different one or just drop the franchise altogether. And we've sat down, went through that feasibility study, and sometimes it makes more sense after reading the feasibility study, and sometimes after that, it's not necessarily the best choice. So, but circling back to something you said earlier too, keeping your books properly and maybe outsourcing that to a good CPA, that goes a long way too, because then you can see exactly what the franchise is costing you, but then compare it to that feasibility study with how much revenue you can keep without that cost.
Yeah, I know we've done feasibility studies ourselves. You know, sometimes it's a great move on the market. Sometimes the market tells you other things, right? But they're great. I mean, you know, you want a reputable team doing it as well, right? You want to make sure they're using great data sets that help tell the story of your market that you're penetrating. So you can get you're making sure you're making the best move. All right. Is there anything else you guys would like to discuss that you think we haven't keyed in on yet during this podcast?
I just wanted to open the conversation up past SBA loans too. You know, I think for the majority of people, an SBA 7A loan will be the most suitable solution. But there are some instances where that may not be a solution they can move forward with. Just to kind of think about another loan here, there are USDA loans, there are SBA 504 loans. Outside of the government guaranteed platform, there are bridge loans, which are useful for short-term funding needs, such as renovations and acquisitions. You could also, depending on the project size, look at mezzanine financing or pref equity, but those are more suitable for mid to large scale products. And you know, in some cases, if it's a small FF&E loan and it's just a renovation loan, there is asset-based loans secured against the existing assets and the receivables for the property, just a typical FF&E loan.
Yeah, I know USDA has been really helping out rural communities in the hospitality sector. I know something more in the independent space being glamping or non-conventional hospitality has been a big help and base for the growth of that sector.
I will
And
say loves those loans. The one-off, not just your traditional hotel. USDA really likes an interesting project.
I was going to say the same thing. It's, you know, I think that's also a loan product that requires a lot of due diligence. Is probably a product that will require that feasibility study. So, you know, it has very good benefits. It's a very good program.
When looking at interest rates on that product, how does it comparable to SBA?
So, you know, I thought about this because I thought this question might come up, kind of, you know, interest rate ranges. And when it comes to discussing typical ranges of interest rates, I think it's helpful to focus on how these rates are determined versus quoting them specifically, as they can vary depending on the loan type, the lender, and market conditions, right? So how interest rates are priced, right? Many hotel loans today are tied to indices such as the U.S. prime rate, which correlates with the Federal Reserve actions. So as we've been seeing on the news, as we've been seeing and celebrating, that prime rate has been coming down. A lot of hoteliers that were stuck in the 11, 12% range, they're finally seeing some relief, not enough relief, but some relief and downward pressure on their payments. But there are other loan types and other lenders that price completely differently. They're the conventional non-bank lenders. They may base their rates on 5-year or 10-year treasury yields, or a combination of private benchmarks. And these indices can behave differently than prime rate, and that creates a variability in the loan pricing. The 5-year treasury, I believe it's 100 basis points, 110 basis points up over the last quarter. And that's not the same story as we've been seeing with prime as it's been trickling down. And so I think it's crucial for hoteliers to understand which index their loan is tied to, whether it's prime, whether it's the treasury, whether it's a different or combination of indexes, because that can affect the impact of future payments.
Yeah, myself expecting as US prime was going down that I could expect lower rates. But yeah, depending on the indices, you never know where the market will take you and who you're dealing with on the back end. Have either of you worked on any USDA non-conventional hospitality products?
I've done several USDA for hotels. And honestly, USDA is a special beast. It really just depends on what office you're working with. Some are really easy and really fast, and you can close in 45 days, and some take over a year. It just depends on the office, and you can't really jump around. It's not like on 504, sometimes you can move to a new CDC if you have trouble. On USDA, wherever it is, that's who you're dealing with. And then over a certain dollar amount, it has to go to the National Loan Committee. But USDA is a lot of paperwork, and circling back, USDA is not a loan you want to do with somebody that you don't have a relationship with, because it is a crazy amount of work, just to say the least. But it's a great product, and it's something that gives hoteliers an option for a loan when a conventional doesn't work, or when 7A doesn't fit, because there's no cap limit to a USDA. You can get over 5 million easily. You can also do a longer amortization on a USDA loan, which is beneficial to those larger projects.
Yeah, I personally have dealt with USDA on REAP grants, and it is not a short time process, right? And I ended up doing it for 2 properties for the REAP grant, and it did have to go to national, and it took forever. But USDA, your local representatives, they're always there to help you, which is one thing I've noticed. They're willing to talk with you and take time with you. So USDA can definitely be a positive for some people in rural communities.
And you would be surprised what actually qualifies for USDA. Even though it has to be rural, they have the map, and every once in a while there's just a little sliver of the map that you would never think qualifies that does. So if you have especially on the development side of things, if you have something you're looking at, for sure check that map and see if it is USDA eligible, because you may be surprised.
Yeah, I think those change every few years.
Census, yeah, so every 10 years.
All right. As we're ending up here, for all the members who joined us, I do want to give you a heads up that we will be sending out information from Addie and Christian So you can contact them if you have any questions, or if you're looking for some help financing any of your upcoming projects. Let's take a look here. Yeah, I believe the AHOA team can send that out to all the members, hopefully in the next week or so. Before we close, Michael, are we able to take any questions from the members? I believe you're on mute. It's on Brandon's computer.
No? Can you hear me? Okay. Yeah, now I can hear myself, so I don't know. Can you hear me? Everyone can hear me?
Yes, we can.
Yeah, so if any attendee, technical difficulties, can't live without them. If any attendee wants to post any questions, I'll be able to see the questions come in and then ask on behalf of whoever is asking the question. And also feel free to reach out. I assume any of you can be reached out to by any of the attendees for any questions that they may have, whether now or later, correct?
Oh, for
Absolutely.
sure. We welcome it.
Awesome. Yeah, right now I don't see any questions coming in, but if anybody wants to post anything, now's your time. I'm sure we'll have more of these, so if you think about something later. I actually do have one that just came in. It just says, let's see. Give me 1 second.
I believe this one guest is asking which loan had higher leverage? Was it the 504 or conventional?
So as of most recently, the SBA 7A has been the higher leverage product in terms of hospitality. In our recent discussions of SBA 504 lenders and CDCs, they are maintaining a 20% equity injection on that used to be able to qualify for 15. And I would say against the SBA 7A program, you can start with 20, you can go down to 10, you can supplement with seller note, you can provide additional collateral. So I think, SBA 7A in that case would be something that can give the best leverage.
While we wait on if any other questions want to come in, would either of you have any other recent stories or guidance for independent hoteliers?
I have a case study, a project that we closed. Let me see what I have here. This kind of went back in our records, right, to see how we helped some independent hoteliers last year. One reference here that I've gotten on a piece of paper. It was an independent hotel in North Carolina. Our team worked closely with the client, his family members who helped with record keeping, and even his previous lender to collect all the documentation needed to complete a refinance. Our president, Rick Patel, actually worked on this himself. It was a close client of his. The client is a small businessman, and we worked hard to demonstrate the revenue potential for the hotel to successfully complete this refinance. In addition, after the closing, we guided the client and his accountant on coding and categorization of the expenses and revenue, so that financial reporting could be more closely matched with hospitality accounting principles.
I think that's super important, especially on a refi with where interest rates are right now, that everything is categorized properly, because the bank is good about adding back certain things, because especially on the independent side of things, obviously there are expenses that get put here and there. So making sure your P&Ls are straight and categorized properly is huge, because then it makes it easier to have a discussion with your lender about exactly what this is when a question comes up.
That's exactly right.
Yeah, one thing we've had to do being independent hoteliers, UCLE format is very important. A lot of independent hoteliers don't go by that, but it's the format the banks love, and it also helps you check your competition on Hotspot, whether your expenditures are the same as your neighboring hotels, whether you're categorizing your spend in certain limits. But yeah, CPA that also understands UCLA is hard.
Well, if I could add to that, right? Another thing that hoteliers should focus on is the reporting and reporting of their occupancy and ADR. Franchised hotels, they're franchise-backed hotels, they have the benefit of SDR reporting, which records the property's occupancy and ADR, and they track it over time. With independently owned properties, many owners that we encounter have handwritten records or just no record at all. So, appraisers really rely on this information along with the financials to track this, to build that appraisal profile out. So if I could give an additional tip, somebody who may be considering going into independent, maybe somebody's first time going into it, you got to track this information daily, and whether that's in a spreadsheet or through the PMS system, or you have a contract of STR, I think it's very, very valuable in your financing endeavors and staying competitive within your market, because then you know where to price.
Even easier, PMS systems nowadays handle all of the difficult parts for you, right? It's great. That's a tool I would recommend all independent hoteliers to focus on, right? Is finding a reliable PMS system that can manage a lot of the data for you. Some include accounting with it, but primary functions tend to be check-in, check-out. But if you can find a robust enough system that you don't need to handwrite, that's what I would be looking for.
Oh yeah.
All right, looks like we don't have any other questions at this time. So I guess I'll leave it to end the discussions at this point. Michael, do we need to do anything prior to ending this?
Nice.
Sorry. I want to thank everyone for it's it's the first one. So thank you everybody for joining. Thank you, Arsh. Thank you, Harry. Thank you, Krishan. Thank you, Brandon. Thanks.
Thank you guys so much for joining us on this first endeavor, a difficult one, but
we're going to get through it. Many more to come. And it goes without saying, if anyone wants to get in contact with any of you, I'm sure you guys have information as far as contact info available for all of our members. Thank you. And I appreciate everyone joining. Tune in for the next one.
Hey, thanks, Michael. Thanks, Josh. Thanks, Eddie. Appreciate it.
Absolutely.
of course.
Bye.
Take care.